Hello and welcome to Livewire's Buy, Hold, Sell. I'm Hunsley. And that recession everybody keeps talking about, well, it still hasn't come. So which stocks would you want to own if inflation comes down, GDP steadies, and rates stop rising? That's right, we're talking the Goldilocks scenario today with Andrew McKee from Elston Asset Management and Rob Crookston from Wilsons. First company, Amcor, of course the global packaging company with food and beverage clients primarily. Andrew, buy, hold or sell?
We'd still be a buy, and we'd be a buy under that scenario. If you look at that scenario from an inflation perspective, that dials back. We think that helps them in terms of their costs, and there's some lag effects in that business. So they put through price increases in both flexibles and rigids, so they get lag benefits. We think if inflation comes off in terms of margins, in terms of GDP, they actually haven't been as defensive as you might think. You know, there's been a lot of change in terms of consumer behaviour. Think of basket size for staples, and if you think of the actual underlying customer in terms of their businesses that they do business with, they've been destocking, decreasing inventories. So although the top line's been growing, it's actually been price and volumes have been coming off. So they've not been a huge beneficiary of this sort of defensive trade, if you like. And then lastly, if we saw rates come off, they're very active in terms of capital management. So we think that decreases interest expense for them. At the same time, it improves, obviously, valuation as well if bond yields come down. So that's a buy for us.
Okay, so it's a buy on Amcor for Andrew. Rob, share price down about 20% year to date. How do you feel about this? Buy, hold or sell?
Sell for us. And the reason for it, in a Goldilocks scenario, we think there'll be a rotation away from defensives or perceived defensives, which we think Amcor is. We've probably struggled to hold it in any scenario at the moment. Low to mid-single digit growth over the cycle. So we struggle with the growth aspect. And really over the last 12 months, we've seen it hasn't had the pricing power in the face of lower volumes and higher costs. And that sort of concerns us as well for, is it really a defensive? Probably not. So it's a sell for us.
Okay. Staying with you, Rob, we're going to go to Fisher & Paykel Healthcare. Of course, the dual-listed company manufacturing respiratory and sleep apnea products. Returned about 20% this year. Buy, hold or sell?
Yeah, it'll be hold for us, Hans. And the key here in the Goldilocks scenario is that we think growth stocks would perform pretty well. So that sort of lower inflation, lower rate, lower bond yield environment that you'd see, I think that would benefit the growth part of the market, and Fisher & Paykel certainly is a growth stock. Probably the reason we're a hold is that I just see there's better growth opportunities at a reasonable price in the healthcare sector, probably stocks like ResMed and CSL over Fisher & Paykel, so that's the only reason we're a hold.
Okay. Andrew, though, it's on a PE ratio of something in the order of about 52. Buy, hold or sell for you?
It's a sell for us, purely on that. It's a good quality business, no doubt, but purely on a valuation basis, extending from what Rob's saying, we think there's better opportunities for our investors elsewhere. We think it is too highly rated for potentially the work they have to do. Obviously, hospitals benefited from COVID. They've got to see the consumable side sort of pick up, and there's a pathway for them to improve margins over the next 3 to 4 years. So from a relative point of view, we think there's better relative opportunities out there. So great, high quality business. We've done a lot of work on it. We like the business, but from a valuation point of view, there's just better opportunities.
Okay. Third stock now, Computershare was touted as a major beneficiary of rising interest rates, but it's actually fairly flat over the last year. Andrew, buy, hold or sell?
It's a buy for us. So yes, the margin business has benefited enormously, incredible increase in their cash flows from rising interest rates. I think that's why you've seen a slight derating, is that people are expecting cash rates to have peaked and roll off, and that would affect their earnings. And no doubt there is sensitivity to that side, but we've probably already seen that in the market. However, the other side of the business, the market-facing side of the business, has actually been quite constrained in terms of volumes. If you think of market activity in equity markets from an issuer's point of view. So in that scenario where we saw a settling down of equity markets and credit markets and a more confidence from the economy point of view, we would think the market-facing businesses do a lot better. At the same time, we're not going back to QE, we're not going back to zero rates. We're still going to have a reasonably robust inflationary environment, and so we think margin business still does well. And so in that context, potentially by 2025, they'll be net cash position. So it's buybacks, acquisitions for us. It's a very strong business at the moment.
Okay, there. Rob, it does have a PE ratio of about 45, so it's another one of these high PE businesses relatively. But 13 out of 17 brokers who cover the stock also say it's a buy. What do you think? Buy, hold or sell?
A sell for us, Hans.
Yep.
And really that's the Goldilocks scenario. It was a rate beneficiary. I think the Goldilocks scenario, again, low inflation, lower rates, lower yields. I just think the market rotate away from those beneficiaries, those rate beneficiaries, and Computershare fits that. So you have to see the rotation in that sort of scenario.
All right, so we've pitched some stocks at our fund managers here in terms of a Goldilocks scenario. Now it's time to see what the experts have brought us. Rob, what is one stock that you think is primed for a Goldilocks scenario and why?
It'll be James Hardie, and I think that scenario, again, low inflation, steady GDP, but really the key, lower rates. That would benefit housing construction and renovation, and that's really the key for James Hardie, being a building materials company. So the macro backdrop would be pretty good for Hardie's in that scenario for us. And what we also like about Hardie's as well is that there is a structural story there, and that's the shift really in the US, which is Hardie's key market, away from timber and towards fibre cement cladding, and that's really the key. And over the last 12 months, James Hardie's has fallen, but really earnings are actually still flat relative to they were in FY22, which is pretty interesting. So probably one of the worst macro backdrops it's had, earnings have stayed flat, which I think shows actually some of the resilience that Hardie's has. But as I said, you've got a good structural story, but I think in that macro backdrop, the structural story should accelerate, which is even better for Hardie's.
I was about to say that US housing market story is going to be particularly important for them. Andrew, one stock prime for a Goldilocks scenario. What have you brought us?
It's Macquarie Group. We've owned Macquarie now for 13 years or so since we started. And for us, the story doesn't really change too much. In terms of the particular scenario, though, if we look at Macquarie's operations, that would benefit them in terms of, say, rates coming down, inflation coming down. In terms of asset prices, obviously the big asset manager, particularly private markets and infrastructure assets. So we think that would be supportive or remove some concerns in the market about revaluation, mark to market of some of those underlying assets. We think it also helps in terms of flows because you're then starting to get to a scenario of looking for yield again. So we think that helps them in terms of net flows, and obviously if equity markets settle down and credit markets settle down, that will help investor confidence generally. We really like the green investment group. The amount of capital that must be raised to drive the transition to lower carbon emissions, energy. Macquarie are all over that. They've recently transferred that division into the Macquarie Asset Management. So they'll go from being more of an asset owner to an asset manager, which is much lower capital requirement for them, more recurring revenues, more performance fees, less one-off revenues. So yeah, we see a scenario where less capital intensity, higher return on equity, and more recurring revenues generally. So we like Macquarie.
All right, so to Andrew McKee from Elson Asset Management, to Rob Crookston from Wilsons, thank you both for joining me.
Thanks, Hans.
And thank you for joining us. If you enjoyed that episode of Buy, Hold, Sell, please subscribe to our YouTube channel and to both websites, livewiremarkets.com and marketindex.com.au. See you next time on Buy, Hold, Sell.